The things about it as an investor at this stage is to understand, for example, the consequences of money printing. You don't get richer because of money printing. It produces inflation and it moves through the system to change asset prices in a certain way. People think that the safest investment is to hold money in cash. It's the worst investment because you lose constantly to inflation. Something like 3, 4, 5% a year would be the tax. So to be able to know how to develop a balanced portfolio, not in any one thing, but to achieve balance and diversification is a very, very important thing. For example, you'll notice that when the pandemic comes along and the stock market goes down, that the bond market goes up, and that the gold changes in this way. Just watch how those movements occur relative to each other. And that gives you a sense of how that balance is going to occur. There's a mistake of a lot of people to think that one asset class is better than another asset class and put all your money in that. If one asset class was better than another asset class, then everybody'd make a lot of money because all you do is go shortly at one that's less good and you go long the other. Markets have a way of handicapping. It's like horses at a horse race, you know. The favorite to win is not going to bet on the favorite to win won't improve your odds because the odds get changed. And so to know that and to be able to achieve that balance is an important thing. That if people understand that and that dynamic, there is plenty of room for optimism, but it is really, you need to understand those lessons of history and see those patterns and understand what we're doing over and over again. And then related to that, man's adaptability and technology and creativity. And so if man can reflect on how do we want to be with each other and how do I want to take care of my finances in a way, the capacity certainly exists.
First of all, there are two types of inflation. There's the supply-demand inflation, when demand is strong enough and it presses up against capacity, like you don't have enough labor, unemployment rates are low, and capacity is low, and then prices go up, and there's that kind of inflation. And then there's a monetary inflation, which comes from the supply of debt being too much so that they produce more of the money. We will have a hell of a lot of demand because we put all that money in. Cash is all over the place. And even investments, all the investments go up because of so much cash. And how do you find a good investment? There's so much money, and it'll change the amount that is in the hands of individuals and so on. Now it's in cash, and that'll move on because cash is trash. I'd say that because it'll have that negative real return. The real risk, you'll experience more inflation. Right now, a lot of it is in cash, and there'll be a lot more money being produced. But you'll experience that more in that kind of inflation. Things will go up. You could see inflation in houses, inflation in, many things is going up. And then you'll start to see probably some labor inflation. If you start to see labor inflation and so on, it'll be a different kind of inflation though, because we're in a more digital society. That supply of digitalization can be produced without the capacity constraint. But the big monetary inflation is the thing. Where do I store my wealth? Because what happens to the markets is then when you go to those other things, let's say you go to stocks, you go to real estate, you go to other things because they're getting out of that. As those prices rise, like a bond, their future expected returns go down. And as they come closer to the interest rate, then there's no longer the incentive to buy those things, and you could have trouble. And it becomes very difficult to tighten monetary policy because the whole thing falls apart. Everything's interest rate sensitive. And so the central bank has got to then print that. Then you have negative real returns in stocks and other assets. When you have a zero interest rate, or in some cases in foreign countries, slightly negative interest rate, and you have an inflation rate of 2% or higher, you get taxed at a rate, essentially you lose buying power at a rate of about 2% a year, and that's a lot. You lose a lot of buying power. And so this is one of those environments you don't want to hold cash. If anything, maybe you borrow some cash and find something that has better than a zero interest rate in it, or something that has inflation. Then the other thing you need to do is diversify well. And the diversification should be currency diversification, country diversification, as well as asset class diversification. Because on average, asset classes and things will be better than cash. The one thing I would say to investors is don't judge anything in your returns or your assets in nominal terms, in terms of how many dollars you have. View it in terms of inflation adjusted dollars. And so cash, like this year, you'll lose 4 or 5% to inflation. And so pay attention to those, because I believe that that'll be the worst investment. Those asset classes on average significantly outperform and will significantly outperform cash. So diversification of assets. I view crypto as a small piece of that. And the message is cash is going to be a problematic asset, and hold that other diversified portfolio of assets, looking at it in real terms, not nominal terms. And that diversification should be also international diversification from countries, not just asset classes, in order to have a truly well-diversified portfolio.